Hey guys, welcome to this video. In this one, I'm going to do a full rundown of the pound against the US dollar from start to finish. As always, don't forget to follow, like, share, comment, and subscribe. And of course, get my free training underneath this video. It will really help you excel if you're looking to make a change within your trading for the better. So let's go ahead and talk about it. I did a euro dollar post earlier, as many of you will know. I'm going to take from the 1 minute and we're going to go back up to the 1 monthly so we can look at the pound dollar and exactly where we're looking to trade it, both myself and my academy members alike. So similarly, again, to the euro dollar, you can see that the pound dollar has fell from the time we reached that financial crisis, okay, when the pound just got absolutely annihilated, okay, and the dollar gained a lot of value. And since then, it's been a continued downwards trajectory. Now, the market has actually been falling for a significant amount of time, longer than that. Okay, similar again to my pound Swiss franc video, but 1917 onwards, and you've come down and down and down and down. But of course, within that downtrend is various areas, various levels, various places where you find the market tends to rebound and you get some sort of retracement. Similarly to what you saw at the point of this financial crisis, retracement back about 50% of the original move. So quite frequently, you are going to get those retracements back up. But nonetheless, that has showed a continuation of the downwards trend in the long term. In other words, the pound is losing value. People are not buying pounds. Instead, they're much preferring dollars as time goes on. And it's really important to get that overall ruling market trajectory, because if you open up something like the 12 monthly, you can see clearly there is a continuous downtrend. Okay, so it tells you where this pair is heading, or at least where you would have been right if you had guessed it was heading down for this significant period of time. So because we're going off probability, because we're looking at purely where price action levels are and how the overall market sentiment and market trajectory is forming, we can get a long-term short bias. But like I said, within that long term, you do have pulls up, okay, and they do sustain themselves for a while. I mean, like I said, you had a lower low here, 2020, but then you spend a year going to the upside. You had a low in September 2022. You then spend almost a year coming back up. And now at this point, okay, you can see clearly you've had your retracement to your 0.618 fib, a mixture of key moving averages. You'll remember, if you follow me or watch my videos, I called it short here. I said, look, I think that's enough, because you just come up for so many months. September 2022, practically all the way up to July 23, with some minor pushes down, really not disrupting anything. Okay, it's just too long. And you can see your stochastic oscillator got very, very high. Now, your stochastic oscillator has dipped slightly, much because the price is moving down. Okay, so we're going to talk about more or less the nearer term. Now we know the long term has an overall downtrend. So if I go on to something like my weekly, for example, now what's really interesting with your pound dollar at the moment is the following. It is the fact that if you look back to September time, again, very similar to your euro, this is showing you weakness, okay? Weak PA. The reason why it's weak is because every single push to the upside is getting rejected, showing you there clearly isn't long side bias here, and people aren't buying in higher levels. And every rejection that comes when it pushes to the downside, okay, is forming that sideways movement. So this is really weak to go off, and you've got a really tight profit margin there. So it's significantly harder to make money in this instance, and you're likely to get a worse position. Now, if it were the case that this was going to boom straight to the upside, it would look more like this. You have a big rejection, and then you've got larger green candles helping it on its way up. All right, you get the same thing very frequently. Now, you haven't had that whatsoever. So it does tell you a lot, doesn't it? It tells you perhaps people aren't buying it at the moment. So therefore, it's a little bit more, again, similarly, a hands-off approach. Okay, I don't think it's done entirely yet, just off recent price action. I think there may be a chance that you can go lower. You're already getting stumped and stopped at your 20 MA. Perhaps you'll get further at your 40. So looking firstly at long side entries, I would much rather, okay, technically it is a long, technically, but I think you're going to get a far better price to the downside. And I think given the way the market's shaping, it may be more likely, or at least fair to say, that you may reach that point. And I would probably call it nearer 117. I've got my monthly up at the moment. Okay. You can see that where you're resting now does coincide with areas of key price rejection formally. Okay. So that is the only upside. But the problem is, like I said, you're not seeing any early entry confirmation. So it could be very, very lightly long on a fall. But I would think more or less you may find yourself referring to lower levels like where I've labeled. So a drip down to this key level of price action, very minor price action, but price action nonetheless, 11735 may be ideal for longs. So technically at the moment, like I said, if you drop to something like your 4 hour, okay, and you come into here, it is technically a light long because you've seen it bounce from here several times. The price has fallen consecutively for a few months now. But I would do that with caution. Now, the story to the upside is actually very similar. Coinciding with your early 40 moving average does give you an early short zone and inherently, therefore, a lower size because, like I said, there's really tight profit margin here. Every single push you've seen previously to this point has been rejected straight away. So, like I said, technically, yes, it's a short, but it doesn't look very convincing when you look at what you've just seen. So you could take a light short, perhaps. Okay, that may be okay. Might be able to coincide with this key level of price action, and you may find your MA start to creep over near a 1, 2, 3, 5. But really, if I was looking short, okay, I'd probably want a larger impulse move to give me something up here. Okay, because I'm going to get far better value on my short entry. And if it does turn out that this is the area the market chooses to continue a downtrend in line with that long-term market trajectory, you may find that's an ideal spot for that to occur. Okay, given what you can see previously on this previous high here, and the fact that, like I said, you've got key levels of price action within near your 126 level. Okay. So at the moment you've got a really low stock oscillator, but don't be one of those people who thinks, you know what, I don't think this can go lower at all. I think this is the end. I think this is so oversold that it just has to go higher. Because if you just look at your price action at this point, it's incredibly weak. And you'll find many times over the course of the market, you have a slump and a slump and a slump, a lower and a lower and lower market. And you find times where it's just teetering and teetering, and then it doesn't go the way you want. Okay. It actually ends up going lower. So, more or less, if you're more confident, perhaps you're more of a scalp trader, you could really hold off. You could be actively trading at this point, but because there's a reduced profit margin, if you're slightly more risk averse and you'd like to give yourself some space and you don't like stress as much, then you'd probably look for swing entries and a move further away. Okay, that would be to something like 1, 2, 5, 7 or 1, 1, 6, 7. But definitely at this point, all you can really see is a sideways moving market. And that doesn't show you much, does it? It doesn't show you that perhaps there is long side impetus just yet. And the pound is losing value and the dollar is gaining value. It's not just this FX pair. It does go for, it does go for many other FX pairs as well in a similar boat. You've got your New Zealand dollar falling, your AUD dollar falling, and so on. So to be absolutely clear, you've had your retracement and now you've had a fallback. I would probably think if you can get to this point, then it may be ideal for shorts to continue the move down within that long-term trajectory. Because remember, the pound has lost value over the dollar for 50 years. If you traded that way, you would have made money. Factually, that's non-negotiable. If you traded short and you continued to short pops, then over the very long term, that's where you would have got. Now, within downtrends, you can also be long, okay? Because they have to pop up at some point. All right. Now, when you're long on a long-term downtrend, you might be long at the right time within an uptrend on a lower time frame. Remember, price is relative to every single time frame, and time frames are relative to the price at the time. Literally, they're just an arrangement of data in a different format, That's all you need to really focus on. Don't get confused. So thanks for watching, guys. Hope that helps. As always, don't forget to get my free training underneath, and I'll see you in the next one. See you there, guys.